Welcome back to the channel. In today's video, we're breaking down one of the simplest, most effective, and most underrated financial strategies ever created: money cost averaging, also known as dollar cost averaging, or DCA for short. If you've ever felt overwhelmed by investing, if you've hesitated because the market feels too high or too risky, or if you simply want to build wealth steadily without obsessing over stock prices, then this video is for you. We're going to talk about what money cost averaging is, why it works, real-world examples, common mistakes, and how you can start using it today. This is a complete guide designed to help beginners and experienced investors alike. Let's get started. Section 1. What is money cost averaging? Let's begin with the basics. Money cost averaging is an investing strategy where you invest a fixed amount of money at regular intervals, regardless of what's happening in the market. For example, $100 every week, $300 every month, $5,000 every quarter. The key is consistency. When prices are high, your fixed amount buys fewer shares. When prices are low, it buys more shares. Over time, this smooths your cost basis and reduces the impact of volatility. Think of it like buying groceries weekly. Sometimes bananas are cheap, sometimes expensive, but you're always buying. Over time, your average price ends up leveling out. That's exactly what money cost averaging does for your portfolio. Section 2. Why it works. Now you might be wondering, why does this simple strategy work so well? There are three major reasons. 1. It eliminates emotional investing. Humans are terrible market timers. We panic when prices fall, and we get greedy when they rise. Money cost averaging removes emotion from the equation. You invest automatically up or down. 2. It reduces timing risk. Instead of risking everything on a single purchase, you spread that risk over time. It's like diversifying not just what you buy, but when you buy. 3. It captures long-term market growth. Historically, markets trend upward. If you steadily buy into that long-term growth, your portfolio grows too, without needing to pick the perfect moment. Section 3. A real example. Let's make this real with an example. Imagine two investors. Investor A, lump sum Larry. Larry invests $3,000 all at once on January 1st. Investor B, consistent Carla. Carla invests $250 at the start of each month for a year, totaling $3,000. Now let's look at a hypothetical price chart of a stock. Jan, $50, Feb, $30, Mar, $40, April, $20, May, $35, June, $45, July, $60, Aug, $55, Sep, $50, October, $70, November, $65. Debt. He ends the year with 60 shares. Carla bought at all the prices. When the stock dipped to $20 or $30, she bought a lot more shares. When it rose to $70 or $80, she bought fewer. At the end of the same year, she ends up with more shares than Larry, even though they invested the same total amount. And guess what? More shares equals more profit. That's the power of buying through ups and downs. Section 4. The market crash scenario. Now let's take a scenario that scares a lot of people: a market crash. Most investors panic. They stop investing. They wait for things to get better. But money cost averaging does the opposite. It keeps investing, automatically buying stocks at huge discounts when everyone else is fearful. This is actually when most wealth is built. You've probably heard the quote, "Be fearful when others are greedy, and greedy when others are fearful." Money cost averaging is the systemized version of that quote, without requiring bravery. During a crash, your regular contributions buy more shares at lower prices, setting you up for large gains on the recovery. Section 5. The psychological benefits. One of the most underrated benefits of money cost averaging is how it impacts your mindset. When you know you're buying consistently, you stop obsessing over short-term price movements. You stop worrying about whether today is a good day to invest. You relax and trust the process. Investing becomes automatic, like brushing your teeth or paying your rent. That mental relief is priceless. Section 6. How to actually do it. Alright, so let's talk about how you can apply this strategy in the real world. You only need 3 decisions. 1. Choose your contribution amount. Something sustainable, consistent, and realistic. $25 a week, $100 a month. 10% of your income. The amount matters less than the consistency. 2. Out. Choose your investment S. Most people use broad market index funds, ETFs, blue chip stocks, cryptocurrency with caution, retirement accounts like a 401k or IRA. For most beginners, something like an S&P 500 index fund or a total market ETF is ideal. 3. Automate the process. This is the most important part. Set it and forget it. Your brokerage probably has an automatic investment feature. Once it's turned on, the strategy runs by itself. You can literally let this run for years without thinking about it. Section 7. Example portfolios. Here are a few sample DCA portfolios depending on your risk tolerance. Conservative, 80% total market index fund. 20% bond index fund. Balanced, 60% total market ETF, 20% international ETF. 20% bonds, growth-oriented. 70% total market index, 20% tech innovation ETF. 10% international, aggressive, 50%. Total market ETF, 30% tech ETF. 20% emerging markets or crypto. Remember, this isn't financial advice. It's educational. Always choose investments aligned with your goals and risk tolerance. Section 8. Common mistakes to avoid. Even though DCA is simple, many investors still run into common mistakes. Let's break them down. Mistake number 1. Stopping during a downturn. This destroys the entire strategy. Downturns are when you get the best deals. Mistake number 2. Investing too little to make a difference. You don't need to invest thousands, but consistency over time matters. Try to gradually increase your contributions as your income grows. Mistake number 3. Constantly switching investments. Pick strong long-term investments and stick with them. DCA isn't about chasing the best stock every month. Mistake number 4. Expecting fast results. Money cost averaging is a long-term strategy. Think in years, not weeks. Section 9. What the data says. Historical data shows that investors who contribute consistently, regardless of market conditions, tend to outperform those who try to time the market. Are there moments when a lump sum would do better? Yes, if you invest at the perfect time. But guess what? Most people don't know when that time is. DCA doesn't try to predict the market. It just works. Section 10. Long-term results. Let's imagine two people start investing at age 25. Both invest $200 per month, but Person A stops during recessions. Person B continues no matter what. By age 65, Person A might end with around $300,000. Person B can end with over $1 million plus, depending on market performance. Why? Because Person B maximized the benefit of buying during downturns. This is the magic of consistency. Money cost averaging is one of the most powerful wealth building tools available to everyday people. It's simple, it's disciplined, it's automatic, and it works even if you're not an expert investor. If you want to grow wealth without stress, without timing the market, and without needing special knowledge, money cost averaging might be your best friend. If you found this video helpful, make sure to like the video, subscribe, and leave a comment telling me, are you using DCA already? Thanks for watching, and I'll see you in the next one.